Okay, let's get started. Let's get the show on the road. Okay, let's settle down and get started. I see some exhausted faces. I wonder why. Okay, now Professor Sinella and I have a bet as to who can make students more exhausted. No, I'm just kidding. Okay, yes. Um, okay, so we'll talk about our next topic, and we'll then talk a little bit about the exam, what to expect, uh, since I just made that up this morning. And we'll do that and go over a couple of things. And as you know, next Monday we have a review session. So please do make sure that you show up for that, because that might be very helpful. Okay, so please do that, and we'll talk about. It's going to be from chapters 1 through 6. That's what we'll review. We'll also go through the assignments for chapter 5 and 6. So that's kind of our agenda for Monday. But today what we're going to do is talk about our last topic in the governmental funds arena, which is the long-term liabilities of a government. You know, it seems like I'm missing a few people for some reason here. We should take a quick roll of attendance. All right? Let's do that. All right. Polling's open. Hit any button you want. Actually, hit the first one. Okay. And since you don't have to worry about the answers, please make sure you do that. Okay? Yes, it's open. It's open. Please don't hit any button except the first part, because that might not work. Okay, good. All right, let's give the P. Well, that filled up the class very quickly. Must have done something. I must have done something, because the class filled up right away. So, okay. Okay. Anybody else needs to press? Guys in the back there, did you get your clickers out? Good. Everybody got it? Everybody all right? Okay, we don't want to miss anybody. All right, good. All right. Okay. So let's go back. Well, that's hard to believe how quickly that class filled up, you know, but anyway, it did. I'm glad. So what we're going to do is talk about long-term liabilities. A couple of things first. So if I asked you next week at a very opportune time, do long-term liabilities show up in the general fund financial statements? No. Okay. They show up in what statements? The government-wide statements. And same thing with the long-term capital assets. So let's not forget that. The reason this is a major area in governmental accounting is, as I was telling you the story last time, because of the tax-exempt nature of government debt, the ability to issue debt at a greatly low rate, governments are tempted to do what? Go out and borrow money. And they do that because not just for low rates, but also to finance all their large capital assets. So just keep that in mind as to why this is such a major area. And who's the largest borrower we know in the world? The US federal government is the largest borrower for that reason. Because just think about it, when the treasury notes are yielding 1%, boy, you're borrowing at literally no cost. But what happens as soon as the rates begin to rise? Well, the discretionary portion of our budget is going to very quickly start to disappear. Right now it's not there, and that's what everybody's afraid of, by the way, at the federal level. So we'll talk about what kind of liabilities are represented by general long-term liabilities. Most of us think of it purely as long-term debt, but it's really not just long-term debt, it's many other things. We'll take a look at some of the journal entries. The journal entries are pretty straightforward in this chapter, except for one area, which is when we talk about term bonds. That's when things get a little complicated, not because the journal entries are complicated, but the way the bond itself is structured. We'll look at how you do the disclosure. You remember the disclosure for capital assets. We now have a disclosure for long-term debt too. We'll take a look at these terms, debt limit and debt margin. I kind of introduced this to you last time a little bit. In New Jersey and many states, governments don't have a free check as to how much they can borrow. It's based on a percentage of the total property value in their community. So, and we'll talk about that. And these are some of the technical terms. We'll take a look at the use of debt service funds and how you budget for them. Okay. So let's take a look at the first thing is, what are general long-term liabilities? When we talk about this topic here, we will not talk about long-term debt of proprietary funds or fiduciary funds. They are separate because they're on an accrual basis. So general long-term liabilities are only associated with governmental funds. You know, the ones that we know. That's it. They're not associated with proprietary funds, and they're not associated with fiduciary funds. They carry their own debt, and they don't have the type of restrictions that we will find here. So you might say, what kind of a debt does a government have? Let's think about New Jersey for a moment. So we have something called general obligation debt. This is the debt which is secured by the state's taxing power. So if you were an investor who bought a bond issued by the state of New Jersey, you would buy that on the premise that the state, if it ever runs out of money, has the power to tax the people to get the money to pay you. So that's general obligation debt. Then we have revenue bonds. These are issued by business type of activities. These are issued, that's why they're called revenues. They're backed by the revenues of the facility. Example, New Jersey Transit wants to go buy $10 million worth of equipment. It goes and issues bonds. Those bonds are secured by the revenues of New Jersey Transit, and that's why they're called revenue bonds, okay? Now there is a third type, which is, it's actually, the term's kind of funny, it's not mentioned in the book. It's a double barrel, which is basically bonds issued by New Jersey Transit, but he would not purchase the bonds from New Jersey Transit unless they were backed by the state of New Jersey. Okay? So now you have an additional security backed by the, they're called moral obligation bonds. And most state entities in New Jersey have that moral obligation. So for instance, you know, the Meadowlands or New Jersey Transit, when they issue bonds, people just don't look to their revenues. They think of the state as being at the back, ready to support those bonds if something does happen. So that's the first thing to keep in mind. The second thing to keep in mind are the types of general long-term liabilities. Now, when you look at the CAFR, you will see this in the disclosure. You'll see tax-supported bonds, long-term warrants, long-term notes, capital leases, unfunded compensated absences, and one of the largest numbers anywhere, unfunded pension obligation, but more importantly, something called OPEB, or other post-employment benefits, which we'll talk about later in Chapter 9 and 10. These are huge liabilities. They are so big that the state's net worth runs into billions and billions of dollars in the negative. State's net position, not only is it not positive, we're talking about billions and billions of negative net worth because of these obligations. Okay, and then we'll talk about pollution remediation obligations. So let's just take a quick look at the disclosure that you will normally find. So this is from the book, and you know there's a lot of stuff. What I want to do is just go over a couple of things. You have all the debt. First of all, look at how it's divided. Governmental activities, and in the next page, is the business type of activities. But let's take a look at the governmental activities first. Look at some of the items here. I don't know if you can read them, but some of the things that you see here are accrued compensated absences, capitalized lease obligations, pollution remediation, post-employment benefits. These are the types of things that you will find in the note disclosure. It will show you the amount of indebtedness at the start of the year, the additions, the reductions, meaning any payments, and the balance for each of the bond issues. It's complicated in this case. It's a real-life example. What page is that in? 212. Let me just go to that. I'm missing the forward page here. And you can see the same thing for business type activities and component units, which we'll deal with later. So when you look at the CAFR, this is the disclosure you're going to be looking at for New Jersey. And you'll see all of these items shown as long-term liabilities. Let's talk about one type of long-term liability which most of us don't think of, which are these things called pollution remediation obligations. And it's very appropriate, especially in New Jersey, because New Jersey is home to quite a few Superfund sites. Does anyone know what Superfund sites are? Yeah, they're like environmental disasters, you're right. They have been designated by the federal government as being the most polluted in the country, and there is cleanup underway, but there are others which are not at that level. So you could have old landfills. In fact, you know, whenever you go buy a home, before you buy the home, what's one of the things that you should do? Well, you kind of drive around, but more importantly, you get into the NJDEP website and look at all the contaminated sites around your address. There might be a gas station, there might be other things. You don't want to be very near that, okay? So these are the things that folks can actually check before they, and you know, the realtor won't tell you because they're out there to sell the property, but especially if you're in an urban area, a good thing to do is to check the NJDEP site for their hazardous waste website, which shows all of these. But let's talk about the liability itself. So apparently these are obligations that are associated with pollution. And basically GASB says the following thing. If you in your municipality or town have an environmental problem, you can't look the other way. If you have, first of all, you know it's an environmental problem. Second, you have some obligation to remediate that, meaning you are a responsible party. and there's been violation of state and federal statutes dealing with that, you have to show the cost of the cleanup as a liability on your statements, on your government-wide statement. So for that reason, a lot of municipalities and towns never take the responsibility, because if they do, what do they obligate themselves to do? Clean up. But in many cases, citizens bring lawsuits against town and make them potentially responsible parties, in which case they need to deal with this. And so what I want you to write down here in your notes is there are 5 different criteria which are mentioned in the book as to when you need to book this as a liability. Please do go through them. I mentioned to you a couple of, which is, there has to be some danger to public health. There has to be a violation of federal or state permit. The government is in some way responsible, and the government obligates itself in some way. So this is the one type of liability which is kind of different from anything else you might have seen. Okay, moving on. I think I talked to you about this. General long-term liabilities are not reported as liabilities of governmental fund. And we'll talk about debt service in a moment. Okay. Now, a couple of things that I want to speak about as far as debt and how we deal with that on a practical basis. So what you will see are these various terms mentioned in the book. One is called debt limit, one is called debt margin, one is called overlapping debt, and these are technical terms for some very simple items. Okay, what are those? You have a town which has a limit on how much debt it can issue. What is that? What is that called? Debt limit. So you ask yourself, how do I figure this debt limit out? I just learned about it. How does that work? Well, in New Jersey, I think for municipalities, it's 3.5% of your assessed valuation. So if your property in your town is $100 million, how much debt can you issue in total at any one time? Can you have outstanding? If it's 3.5%. Well, it'd be 3.5% of what? 100 million, which would be what? 3.5 million, right? So there are limits in New Jersey as to how much you can have, towns can issue. And why do they do that? They do that so some crazy politicians don't go about issuing debt right and left, and who are going to end up paying that debt? Property, taxpayers, right? So the state came up with this general rule for 3.5%. And since in New Jersey, besides towns, what do we have, Amanda? What's the next part? Who's on top of the counties? Counties have a limit of 2%. So it's 3.5% plus 2%, right? So each layer of government can have its own limit. Now, the county's debt is known as overlapping debt. You see that? Because the underlying debt is direct debt, which is the town's debt. The county's debt is on top, which is the overlapping debt itself. So what's the total in terms of direct and overlapping? 5.5% in New Jersey. So debt limit is simply what is the maximum amount of debt can I issue? Okay. The next item is that we'll go through is, so let me see if I, do you know, has anyone seen a property tax bill from a town? Well, hopefully you'll be getting one soon when you go out and purchase your first home, right? Basically, when you get the bill, the tax bill, it says your land is worth X amount, your improvements, which is all the house, is worth, so land is worth a lot in New Jersey, mostly. So the land might be worth $300,000. The home on top of the land is, let's assume, $200,000. So now your total assessed valuation is $550,000. They multiply that by a tax rate to come up with your taxes, which you have to pay in 4 installments. But in New Jersey, what happens is when the town collects those taxes, it's like think of a pie with three pieces. The first slice goes to the town to pay for, administrative, police, fire, all of this. That's one slice of the pie. The second slice goes to the schools, which is a big slice. And that is used for education of school kids and so on and so forth. And the third slice goes to the county for county functions. Okay? So that's how New Jersey's tax bill is made up of, those 3 slices. Now, and I wanted to mention that to you because that's usually not the case around the country. Things are done a little differently. So if you read in the book, things shown in a certain way, you will see, you'll get to see the context in which they are placed. In the case of a New Jersey town, you're being taxed by the city, you're being taxed by the school, and you're being taxed by the county, right? Those 3. And these are the terms that I want you to be familiar with. Debt limit is the ceiling on the amount of debt defined as statutory percentage of assessed valuation or other valuation of taxable property. And debt margin is the difference between the debt limit and the amount of debt outstanding. So you had a town with a $100 million valuation. The percentage was 3.5% of the amount of debt. So how much could they, what's their debt limit? 3.5 million, right? They already have issued $1 million in debt. So what's their debt margin now? 2.5. Get the difference? Debt limit and debt margin is what? Debt limit minus what's been issued is equal to debt margin. So don't get confused. They're simple terms, but debt margin is your borrowing capacity. How much do you have left? Okay. So for instance, let me make things a little bit more complicated. If you had debt which was authorized but not issued, remember that example, $3.5 million debt limit, $1 million of outstanding debt, but you have another $1 million of authorized debt which has not been issued. Does that come into the calculation? No, because it's not been issued yet. If it's debt issued by, if it's a revenue bond, that doesn't come into it either. It's basically municipal geo debt that shows up here. Let's see if we can take a look at some illustrations here so you can get a feel for how this works. I think one of your homework questions deals with this. I want to just show you how this is shown. Okay, so take a look at, so this is the legal debt margin information presented over 10 years. What's the first line? Debt limit, right? And remember what I said to you, debt limit is calculated by taking a percentage of the assessed valuation. That's how that is calculated, right? The next is total debt applicable to the limit itself. That's the outstanding debt. And in this year, how much of the debt limit have they used up already? 54%, right? Everybody see that, right? Now the bottom part. This is, and actually I'll try to make this a little bigger because I know it's hard to read. Okay. In this case, look at the calculation. All the property in this is worth 3.6 billion. The limit is set at 5% instead of 3.5% in New Jersey. So what's the maximum they can issue? 182 million. How much have they issued already? 201 million. These are, what kind of activities are these? Are these governmental or business type activities? And business type of activities should be what? Should not be included, right? And then you have amount that's available and which can be used for retiring debt, and we show that. So the total number comes up to 98 million, and this is the amount of margin that's there. Now this example is a little bit more complicated because it's a real example, but you get the gist. You get the gist of this calculation. You get that you don't include business type activity debt, and any amount that's available already to be used for debt service, that's taken into account too. By the way, the question that's for the homework isn't as complicated. You should be happy about that. Okay. Actually, let's just see if this is, there's nothing like doing a real question. Okay, let me go back. Let's take a look at page 241. Take a look at this. You have to calculate two numbers, debt limit and debt margin. All right, so who wants to volunteer? Let's do the debt limit. Who wants to volunteer calculating the debt limit? You raise your hand? Sure, go ahead. Miss, what's your name? Nina, okay. Of the 10 billion? Is that what you're saying? Good, excellent. Yeah, all right. Okay, let's give her a applause. That's good. All right. We need to get people going. All right, since you're, so what's that? That's about 100 and, I tried to do the math here, 108 million or something like that, right? And what's the, now comes the really hard question. What's the amount of the debt margin? So what would I subtract from that 108 million to come up with the debt margin? Excellent. Let's give her another hand. All right. That's great. Okay. Now, let's think about the answer for a moment. Let's start off from the bottom. Capital leases outstanding. I never said anything about that, but it seems that we do not include capital leases as part of debt which is issued, right? We did not include that in that calculation, right? So capital lease obligations are excluded from the debt margin calculation. What else is excluded? Revenue bonds are excluded, right? And approved but unissued tax-supported debt is also excluded. So the only number that's included are the GO serial bonds. Okay, so now if you are working for Moody's, Fitch, one of the credit rating agencies, this is the type of stuff you'd be looking at. And we'll deal with this more when we get to Chapter 10, which are the measures to see how you're doing. And just as in any place else, you know, you have folks who have a lot of debt and those who don't. Well, governments, there are many which have a lot of debt and there are others who don't. And these are the measures that are used. Ratio of debt to population. How is that calculated? Take the total debt and divide that by the population. Now, some people might think, what does that tell you? Well, it might tell you something, you know. Something else to keep in mind when you're going out to purchase your first home. Look at these measures. This tell you a lot, okay? Ratio of debt to estimated true value of taxable property. Well, we know in New Jersey it was 3.5% plus 2%, but not everybody uses that entire number. It'd be nice if they don't use their entire debt capacity, because if something does go wrong, what happens? They're in trouble. Ratio of debt service expenditure to total general expenditure. No different than the way we deal with things. If you made X dollars and you spend 70% of it paying your credit card bill or your fixed costs, well, there's not much discretionary income left. Same thing with governments. Debt service is not discretionary. You have to make that, right? So that's another thing. And then you want to look at multiple year trends to see how, you know, whether things are getting better, or the same, or getting worse. So let's just talk about now debt service funds. And first, you do not need, you're not required to have a debt service fund. You can fund your payment of principal and interest through the general fund. But we do that because sometimes the bond resolution or the bond indenture require that you put aside money for principal and interest. Why do people who purchase your bonds might want to do that? Well, they want to make sure they get paid. If there are problems or issues, they want to make sure that they get paid. And the bond resolution might in fact require you to deposit 1 year's worth of principal and interest in advance in a debt service fund. In that case, what do you need to do? You need to have a debt service fund. Debt service funds are temporary. Once you have paid off the debt, do you need the debt service fund? No. Do you carry the long-term liability in the debt service fund? No. Okay. Where would the money come to pay for debt service? Property taxes, sales taxes, special assessment taxes, as you see. And basically this is what happens. The general fund collects the taxes and sends it to the debt service fund, which then cuts a check out to the trustee, who then cuts a check out to the bondholders. That's how in real life this occurs. It says the number of debt service funds should be held to a minimum. You know, if you look, when you look at New Jersey CAFR or some others, you'll find 20, 30 bond issues. You don't have to have a debt service fund for every single issue. You could have one debt service fund and you could code it so you'll know which, the funds belong to which bond issue. So what is the purpose of debt service fund? One and only one purpose, and a very simple purpose: to pay principal and interest on maturing debt. That's all. Couldn't be more simpler, and don't make it complicated. That's it. All right? Now we'll talk about the different types of bonds that are out there. Serial bonds. These are the ones which are the most common. And what you'll see is the book talk about different types of serial bonds. There's a regular serial bond, the deferred, the irregular, the annuity. Please make sure you learn the differences between each one of them. But basically, what happens with serial bond, the thing that characterizes them is the very first bullet. Principal matures in annual installments, and so you might say, that seems obvious. I need to pay principal every year anyway. No, as we will see shortly, there is a bond where you don't need to do that, which is the term bond. Okay. So how does this work? You issue $1 million, and we'll go through an example. $1 million bond, and you've got 10 years to pay it off. What's your annual installment? $100,000, right? So you're paying off what? The first year you're going to pay, and let's say it charges an interest of 5%. What's your first year cost? Repayment of principal of $100,000, and 5% of $1 million is what? $50,000. So my first year debt service expense is what? $100,000 in principal and $50,000 in interest. What's the next year? Again, $100,000 in principal. What's the interest now? 5% of $900,000, because I paid $100 already. So my next year's interest is $45,000. Do you see what happens with serial bonds? Your total debt service declines, right? And the reason why it's important to note this is when you go out, buy a home, and you get a mortgage, you'll get an amortization schedule. What does the amortization schedule show? Does it show declining payment? No, it's what? An annual monthly payment, which is the same each month, right? What's changing in that annual payment? Principal and interest. When is interest the highest? At the beginning, and principal amortization is the lowest. So you borrow $200,000, and the first year you look at your bill and you look at the breakdown, you say, gosh, I paid $15,000 on my mortgage, and I only paid $1,000 worth of principal? You can't believe that, but that's true. Because that's called what? An amortized loan. We're not dealing with that. We're dealing with the serial bonds. Term bonds. Let's take a look at the term bonds. These are a little bit more complicated. And these are, fortunately, they're not used that often, which is good in some ways. And this is the way this works. You borrowed $1 million. You only have to pay 5% interest. You say, wow, this is a great deal. So what do I pay every month? I pay $25,000 every 6 months, I'm sorry. What do I pay? $25,000 because it's what? On $1 million, right? But at the end of 10 years, I need to pay that $1 million back. Now, as a financial manager, you can look at it this way. You can say, this is wonderful. I just need to pay $50,000 every year. Year 10, when it's ready, I'll deal with it then. Do the bond investors want you to look at that way? No. They want you to do what? They want you to deposit money every year in a debt service fund. So you say, all right, so $1 million, I got to put into an investment account. If I put in, what do I need to do, place into my investment account every year, so at the end of 10 years, it will equal $1 million. No different than a question as follows. I am, whatever your age might be, you say, you know what, I'm 27, 28, at 65, I'd like to have $10 million. It used to be $1 million, now we'll change that because it's $10 million. What do I need to put into my account every year to have 10 million when I'm 65? That calculation uses the future value of an annuity. If you've studied finance, there are 4 things you never forget, and you always keep these. You should know them like the back of your head. How to calculate the present value of the sum, how to calculate the future value of the sum, how to calculate the future value of an annuity, this example, or how to calculate the present value of an annuity. But more importantly, when to use what, which technique to use. You cannot graduate as an accountant if you don't know those 4 things. They're very, very simple there, but it's very important. In this case, what are we trying to do? We are trying to come up with the future value. That's why it's called future value of an annuity, because an annuity is what? Periodic yearly payment. So we'll take a look at this calculation of how this is done, but the accounting is not as complex as the risks that are taken. Basically what it says is, I'm going to invest a certain amount every year, which is going to yield me a certain amount, and at the end, it's all magically going to be, you know, $1 million. Will it happen? It could, and usually want more rather than less, right? And that's the amount that goes into your debt service fund. So that's the other piece. Now, there's a third bond which is not mentioned here, but you know, it's interesting. When I started in school, I wanted to be an accountant, became an accountant. After I got through it, I realized it was too boring. And I said, you know what? I don't want to look at historical stuff. I want to look forward. I want to be able to do something with it. So at that point, I got my MBA in finance. And that was one of the best things, because the finance really, the combination of finance and accounting is really wonderful. And unfortunately, you don't have many accountants out there who really have the financial skills. And by this, I mean hardcore financial skills to make for a good accountant. And that would be my advice to you, is to go along the same way, because what it will do is it will give you accounting in a whole different light. And but the example that I wanted to mention to you, I don't know if any one of you have heard of zero coupon bonds. The Treasury issues them. They're called strips. They're where the interest has been stripped out of the bond. So basically you pay for a $1,000 bond which matures in 30 years, you pay $50 today or something like that, and then it accretes principal and interest. And that's the third type of bond which is not shown here. And I think I know the reason why they're not shown here, because deeply discounted bonds have a very high price volatility. The prices go all over. Just a little movement of interest rate can cause dramatic fluctuation in the value of the bond itself. But let's go back to this. That's the third type of bond, which is deeply discounted zero coupon bonds. The accounting principle and procedures for debt service, you use modified accrual. Now this is something I want you to remember at least next Wednesday, okay? And let me explain to you what this is. And again, this might seem to you a little odd, but I want you to take a look at this example, okay? And let me give you this, this example of how this happens. And this is a strange thing about modified accrual basis. Let's assume you issue a bond on January 1, 2013. Everybody got that? The first interest payment is 6 months from then. So when does the first interest payment come due? On 7/1, right? You need to make what? Interest payment. When does the next interest payment come due? 1/1/2014. Not at 12/31, it's the first of the month, right? Everybody got that? In commercial accounting, what would you do on 12/31? You would accrue interest, right? Because you've paid what? 6 months of interest on July 1. The next interest payment is due on January 1. So what would you do in commercial accounting? You would accrue the interest for the 6-month period, right? In modified accrual basis, we do not accrue it. We do not accrue interest unless it's legally due. The word is legally due. When is the interest legally due on this bond? 1/1 and 7/1. So the first year, when do we pay the interest? On 7/1. The second year we make the interest payment on what? 1/1, and then again when? 7/1. So now we're good, right? We've got 2 interest payments in 2014. But the first year we're short 1 interest payment, right? That's okay. So that's the modified accrual basis for interest. By the way, this is not a good example, and I don't want to confuse you, but under GASB rules, if an interest payment comes due within 1 month after the close of the year, you are allowed to accrue it as long as you have money available. But I don't want you to, if you read the footnote and you get confused, that's why there's a little footnote in the text. But this is the rule. So let me ask you again. During the year 2013, if you issue a bond on 1/1, when will your first interest payment be? 7/1. When would it be second? On 1/1, which means that you only recognize 1 interest payment. Okay. And it's when it's legally due. And the same rule applies to principal too. Okay, because and how does it work? It basically works like this. The principal is paid once a year. Interest is paid what? Twice a year. And we do use budgetary accounting. We do not use encumbrance. There's no need. We're not purchasing anything. Okay. And so everybody got that, right? The special rule under modified accrual for interest. For term bonds or deferred serial bonds, additional revenues, you need to place money into a sinking fund. What's a sinking fund? That's a strange name for a fund. Sinking fund, right? This is the fund which holds monies until they are needed to repay the bond. Okay. And we'll take a look at how this all works. The schedules and the statements are shown in the book, and I want you to take a look at those, please. It shows you the combining statement of revenue and expenditures and changes in fund balance as well as balance sheet. Those two statements, balance sheet and statement of revenue, expenditures, and changes in fund balance, what's so unique about them? They're used for every governmental fund. Special revenue fund, capital projects fund, debt service fund, they all have those two statements, balance sheet and a statement of revenue, expenditures, and changes in fund balance. Note, interest to be paid in future periods is not recorded as a liability of the government itself. And now we'll go through a couple of examples. This is the example that I was, actually, I did that. Assume bonds are issued on January 1, 2014, pay semi-annually. What amount of interest would be recognized? I just gave you that, only one, which is on July 1, and that's it. Okay, now a couple of things about accounts, and we'll see how this works. In order to make interest and principal payments, you need money from somewhere, right? Where does that money come from? The general fund. And that money shows up as estimated revenues. We'll take a break shortly. I see some glazed eyes, I'll tell you. It's very hard to be up here teaching and seeing this. I kind of feel sorry, you know, to subject you to this torture. But I know, you guys look like you've had it. You guys look like you need a nap. Okay. But that's why I have to tell you these stories to get things going here, you know. So let's just think about this. What are the budgetary accounts in a debt service fund? The budgetary accounts, one is what estimated revenue, right? Because that's a budgetary account. That's where the money is being received, right? And what would you spend it on? You'd spend it on principal and interest payments, okay? And I want you to remember this, and I want you to start to follow this in this journal entry. Now please do take a moment just to read this illustration. City issued 100,000 of 6% serial bonds on December 1, 2013. Note the date, December 1. Interest on the bond of 3,000 is due on June 1 and December 1 of 2014, and in decreasing amounts every year for the next 19 years. Why is it decreasing, by the way? Because you're retiring the principal, right, each year, right? So if you retire 100,000 over 20 years, your principal is, how much are you retiring? 5,000. Everybody got that? Over 20 years, right? This is what happens at issuance, at the governmental activities level. You get cash and you recognize a long-term liability of 100,000. Pretty straightforward at the governmental activities level, which is full accrual basis. Now I want you to just think about how we came up with this 11,000. This is the budget. We need to pay what? $5,000, which is the principal. And what was it? 6% interest, right? 6% of 100,000 is 6,000. 6 plus 5 equals 11. We need from the general fund 11,000 and our appropriation or expenditure is going to be 11,000. So we just recorded the budget, completely balanced. Why does it say no entry needed? What, Andrew? Well, we don't record budgets in the governmental activities, remember? Actually, that's a question, I just remember. Okay. Trying to motivate you. Okay. On May 28, 2014, a transfer from the general fund is received. Well, they got their first transfer on May 28th. Why? Because I think the first interest payment is due June 1st, right? Of 3,000, it shows as other financing source interfund transfer in 3,000. Why no entry again? Didn't they get money from the general fund, the debt service fund from the general fund? It's just a transfer between two governmental funds, and governmental activities is what? Has all the 5 funds together, right? That's why we don't show it. The first interest payment is made. Very simple. Expenditure, bond interest, 3,000. We credit cash, debit expenditures. Instead of expenditure, we now call this what? Expense, because it's on accrual basis. Now comes the next installment, December 1. They need $3,000 for the interest and $5,000 for the principal. They get the cash from the general fund, and they, on December 1, pay this number out. Anybody not understand that? I thought what you're going to say is, I understand it. The question is, will I remember it? Okay. Right? Okay. Expense, interest on long-term debt. And notice, what do? We reduce the payable by 5,000. Why don't we show that here? Because we don't carry the liability. We do not carry the liability in the debt service fund or the general fund. That's why we don't have that. At the end of the year, and this is what I want you to pay attention to, not in the debt service fund, but in the governmental activities, we recognize 1 month of accrual. What is that month? December 1st to December 31st. And that's the accrual that we need to recognize at the governmental activities level. But it's not accrued on the debt service fund. All right, we'll do closing entry and then we'll stop. This was the original budget entry, which we just reversed. And we are closing the expenditures account because they were debit, now they're credit. And that's all right. So let's take a break and we'll come back. Make sure you get yourself a cup of coffee or something. So for our next half. Okay, and we'll take a look at the term bond example. And okay. So let's get started again. I want to talk about the exam. I see we're missing a few people. Maybe I'll wait for a few minutes and then we'll talk about that. Okay. So as you, we have our exam next Wednesday. And what I've decided to do for the exam is that I'm going to give you a all multiple choice exam. 50 questions. 50, 50. Okay? And yep, it's going to be all multiple choice, and 50 questions. And the way it's going to work out is that most of the questions relate to testing you on your conceptual knowledge. But there will be questions, a few questions, which will test you on your ability to remember some key journal entries and the accounts involved. And that's what I'm going to talk about on Monday. Okay? So that's what we'll do as far as that. And I'll talk to you about some of the calculations. There's no real math that you'll need to do, but I'll talk about some of the numerical questions that I have there. And let me just give you some hints on how to study for the exam itself. Okay. I don't know if you're aware that the book has a companion website on which for each chapter there are 20 questions, multiple choice questions. And what you should do is first you should try to, oops, sorry. Here we go. I'm seeing this here. Okay. I'll have this come up so you can see what that is. It's in the first chapter itself. It gives you the website for this. And basically what you have under the student edition is the, by each chapter, you have the multiple choice quiz. And basically what you do is you go through this and you test yourself after you have studied. Okay? The questions aren't going to be, there'll be a mix of easy, medium questions, nothing that you should not be able to handle. If you were in the class, you listened to what I said, you took some notes down, you weren't on the computer doing other things, you should be fine. Okay? Because it really, that's what it is. If you did the homework assignments, some of them, you will see, you'll look back and say, yeah, I think I was asked that question, how to do that, or that multiple choice question that I saw. So that's the way to study for the exam itself. I'm not going to go into to find some great detail on some item and ask you a question on that. Not going to do that. I'm not going to go to that level, but I might ask you, is this statement prepared on a modified accrual basis or accrual basis? How do I book interest? Things like that, questions that I emphasized in the class. And if you took some note of it, I think you should be in good shape. Because that's what I did. I went back and I recalled that. And I know some of you do take down, because I can see while others are busy on the computer, or maybe they're taking some notes down, which I hope they are, because there's a lot of material. And you probably saw that as you read this, it's overwhelming. You'll say, where do I begin with this? And unless you have a game plan, it's going to be hard for you. Okay? So we're going to try to see how things go. And please do show up on Monday, because as I said, I'll try to do something which is pertinent in with learning of this. Any questions? And usually I like to, yeah. Yes, you can. Yes, you should be able to access the website. It's actually, if you want to write it down, I can give you the website address. It's www.m as in Mary, HHE.com/rec, RECK, 16E, 16th edition, 16E. So www.mhhe.com/RECK16E. Okay, and you should be able to go into each chapter, but don't do that at the start. First, learn a little bit about it and then test yourself. Okay. So what you want to do is go through that and go through also the multiple choice that we did in class. Okay. Yeah. Yes. Did you have a question in the back? Somebody here. Oh, all right. Yeah. Good. Anybody else have any questions? Yeah. The whole period. You'll have plenty of time. Time's not going to be an issue. Time's not going to be an issue. You should be okay with as far as timing goes. We're going to try this to see how we do with this type of a test format. I've used different test formats, but I think this one will, there are advantages and disadvantages to giving problems. Some people totally bomb out and they really lose a lot that way. So we're going to try to test you on a variety of areas. And you know, a lot of them are CPA type of questions, so hopefully that will also help you. And you know, in that preparation, this course isn't just meant for that, but it would be good to have that. Okay, let's take a look at our next part, which is looking at the same transactions from the term bond perspective. Everybody know the difference now between a term bond and a serial bond? When does the principal on a term bond come due? At the very end. What about the serial bond? It comes due every year, right? So this is what we're doing. We're working on the term bond, and we are going to take a look at this. It's a 5-year term bond, $100,000, matures in 5 years, so we need $100,000 in 5 years. And they will make interest payments every 6 months, and it earns 7% per year, and that's what we are going to see. This is the factor, that 5.75 is the future value of an annuity factor. And it's interesting because basically in this case you have an annuity of 5 years at 7% per annum gives you this factor, and if you divide that into 100,000, this is the annual sum that's required, 17,389. Now you might think, what does that mean? If you needed $100,000 5 years from now, and if you had no interest, how much would you need to put every year? 20,000. So why do we put less than 20,000? Because we are earning interest. And lo and behold, the beauty of future value calculations is at the end it gives us what? What we need. What if the interest rates were lower than 7%? What would happen? Would we have 100,000? It would be less. What if it were more than 7%? Would we have more or less than the sum? We'd have more. This calculation amortization table is important because this is what is used to make the journal entries. So when you sit down with this, you need to have this amortization table in front of you to make your journal entries. This is the amount that you need to put in every year, and this is the amount that you will need to receive as income every year, so that you have 100,000. 23, the first year. Try to figure this journal entry out. Let's go back. 23,389. How do I get that number, 23,389? It's my first principal payment of what? 17,389. Interest at what? 6%. On 100,000 is what? 6,000. 6,000 plus 17,389 gives me what? 23,389. That's the money I need the first year. Why is this split up this way? Well, we need $3,000 for the interest that's due on July 1, and this amount will come due the following, gets deposited into the sinking fund after we have taken that. Look at this. Amount coming from the general fund, due from general fund. This is a revenue source. Now, some of you might look at this and say, wow, this is involved, and it is involved. It's much more involved than the serial fund calculation. On 7/1/13, you get $3,000 to make the interest payment on July 1, 2013. And again, the cycle starts again. There's a similar example of this in the book. I want you to just go through it. It doesn't have the same numbers, but it is a similar example. The problem with showing these here is that if you miss one thread, you lose the whole example. But what we are doing here basically is each year we're getting the principal number, which is 17,389, and what? The interest, which is what? 6,000. Every year. We're doing that each year. The 6,000 we are paying to the bondholders, and 17,389 we're putting it where? In our investments, so that they can grow to 100,000 at the end of the 5 years. And again, sinking fund, they invested, look at this, credit and debit into investments. There's a whole topic in the book about investments. Shows you the closing entry. And notice the fund balance is growing. Why is the fund balance growing? Because that's going to amount to hopefully $1 million at the very end. Okay? And this entry continues 2013, 2014. But I want you to see this. This is the second year. 23,389, we talked about how that number. Where did this 1,217 come from? That was the earnings on our investment, if you look at it. 6,000 represents 2 years worth of, a year's worth of interest. 17,389 plus 1,217 gives us the amount that goes into the budgetary fund balance. And this continues. This is the budget number, and we will again pay our first interest payment. Our second interest payment comes due soon. And I won't go through every one of these, but this is what's happening each year. Notice what happens. In 2014, they anticipated what? 1,000, what was the number they anticipated? 1,200, wait a minute. They had anticipated 1,217. It's right here. How much did they receive? 1,517. Good or bad? They did good. So they have a cushion of what? $300. And that's what happens each year. And at the end, hopefully, you'll have the money. So do term bonds carry a certain risk? Yes, they do. Because if your assumed rate of interest is wrong, you can be in trouble. As I said to you, there's a very interesting piece here about investments, and you should read that because it's more than, it applies to more than governmental accounting. The risk that I just spoke about is called what? Interest rate risk. Interest rates could be more or less than the rate that you, more is good, but if it's less, you're in trouble. So we have interest rate risks, we have market risks, we have institutional risks, we have concentration risks. these are all financial things that are not really part of this course, but as accountants, you should understand. Because you know what? They'll be looking at you as accountants to figure this out. They're not going to say, oh, you know, I only studied accounting, I didn't really study the other aspect. They're going to look at you as if you do know this, and you need to understand this. And that's why it's good that the book mentions this. There are different types of risks involved. And again, the journal entry continues for 2015 and 2016 until the very end. And this is I want to show you the entry at the very end that occurs. Okay. The budgetary fund balance, we wanted what? 100,000. And now we have the 100,000 plus the $3,000 in interest. Look, if you don't, I know I'm going through this quickly, but what I want to do is just show you the key points, because this will take quite a bit of time going through slide by slide, because they show you examples over 3 years. Okay. The bottom line is they have $500 left. So how much did they put into the sinking fund? All together with the earnings, they had what? $100,500 left. And what do? They transfer it out to the general fund, hopefully, and the debt service fund is now closed. So as you can see, term bonds, journal entries are much more complicated, because you need to each year pay the interest, which fortunately is constant every year. What was it? 6,000 every year, right? Why? Because you weren't amortizing any principal. And each year put in what? The principal, the sinking fund payment, and book the interest that's received. And there we go. It's restricted, transferred out. It was restricted, now it's transferred out to the general fund. Bless you. Now we'll go on, move on to so in this chapter, the most complicated part is the issue of term bonds. What do I want you to learn on term bonds? Not all the journal entries. I want you to understand how they're structured. What does it mean? What does a term bond mean? When does the principal come due on a term bond? Okay. What is a sinking fund for a term bond? What does that mean? What gets deposited into the sinking fund? Where does the money come from? Concepts like that. Because you know what? You can always pull out the calculator, you can get somebody, they can do the math for you. Or you can do it yourself. But these concepts are important. Okay? So how many types of bonds did we deal with so far? Serial and term bonds. And there are various flavors of serial bonds, right? Now we'll take a look at a different type of debt, which is associated with special assessments. And I think you recall when I spoke about these special assessments, first of all, see, this is, if you had like a little study group, that's always good to have, because we always practice this way. 3 people get together, talk about what is special assessment? Well, special assessment is a special type of property tax, which is what? Levied on property owners who benefit from a certain improvement. So if you decided to put a sidewalk in a new development, everyone's house, which is adjacent to the sidewalk, has to pay for the cost of that. So you say, why special assess? Well, each of the owners, you know, somebody wants to do it this year, somebody wants to do it next year. Well, the sidewalk's not going to work that way. The whole thing has to be done all at once. So the property owners all get together and they say, look, if we all work together, we can get cheaper price, and let's go to the town. Maybe they can do this for us. The town says, yes, I'll build you the sidewalk, but I want you to pay for it. And you say, well, I'm ready to pay for it, but can you stretch out my payment so I don't have to pay it all at once? And the town says, yep, you can pay it over 10 years. But you have to pay interest because I have to borrow money. That's special assessment. And these are the journal entries associated with special assessment. Now there are some other questions. What if that homeowner who promised to pay every year the special assessment disappears and does not pay his or her share? Who's caught with the bill to pay? The town. So the town has what? An obligation to pay the debt on it, right? So it's primarily liable for it, right? Or secondary liable for it. So that's one thing to keep in mind. In most cases, that's how special assessments work. If the property owner does not pay, the town has to pitch in. However, if you have a town which says, all right, I'm selling these special assessment bonds, but you know what? If this person doesn't pay, it's your business. I'm not paying you. Is the town now guaranteeing the debt to the bondholders? No. It moves from this category to something called an agency fund transaction, where the town has no responsibility for the debt. If the town has no responsibility for the debt, it is accounted for in agency fund. What's unique about agency funds? They're not part of government-wide statements, right? They're not part of government-wide obligations. So whenever somebody says special assessment, the first question you ask them, who's on the hook? And the person says, the town will always be on the hook, special assessment debt service. If they say, you know what, we're just doing this, we're not involved with it. Once the debt is issued, it's your business. Between you and the bondholders, we're not getting involved. Then it goes into the agency fund. Okay? And that's why I say if the government is not obligated in any manner. Here's a special assessment, and I want you to just look at the journal entry. It's not really difficult, but you need to see what's done here. So there was the example. They put the sidewalks. Boy, it costs a lot of money, $1 million, to be paid over 10 years. So what I want you to do right now is, this is day one. Nothing's happened yet. I want you to, in your mind, think about if you were to eliminate these two lines. The first line, assessment receivable current, and revenue receivable, and revenues. Did I say eliminate? No. Keep these two lines, eliminate these two lines. The second and the fourth line in your head. How much is the town going to be receiving? 100,000, and it's going to show 100,000 as revenues, right? Next year, what would it do? The same thing, right? 100,000 receivable and 100,000 in revenue. What we like to do with special assessment is we like to show the entire deal. What we do is we say, yes, they're receivable in the future, deferred, 900,000. And revenues also deferred. Next year, what is going to happen? We're going to reduce this by, and reduce this by, and make this entry, right? Everybody got this? Let's do this again. Next year, we'll only have now 800,000 deferred because we'll make 100,000 as current revenues and assessment receivable. That's the most complicated thing about special assessment debt service fund. Now, what in the world is this 80,000? Where did that come from? Well, remember, that was the principal. We need to pay what? Interest. What was the interest? 8% of 1 million, which is 80,000. So how much did they actually receive from the property owners? The 100,000 which is already booked, 80,000 in interest, so the total amount they received was 180,000. Now some of you might say, why don't you show receivable as principal plus interest? Well, it's not due till the end of the period itself. So that's, and it happens, by the way, that exact entry will occur every year for the next 10 years. Except for one fact, which is what? Would the interest be the same? What would be my next year's interest? 72,000. What would it be the year after? 64. Do you know how that was calculated? 900,000 times 8% is 72. The year after, how much do you have outstanding? 800. 800 times 8% is 64. And now what's happening? The interest is declining. Yeah. And there it shows the amount going to principal and interest in the special assessment debt service. And again, look at what happened next year. We took it out of deferred, made it current. Took it out of deferred revenue and made it current revenue. We do that each year. This journal entry stays that way. Let's just take a quick look at capital leases now. We looked at special assessment, capital lease transactions. And I think we talked about this a little bit. So in order for something to be classified as capital lease, do you have to meet some criteria? Remember those, okay? Assume for a particular capital lease, the unpaid lease obligation at the beginning of the year was $57,590, and a $10,000 lease payment is made at the end of each year. If the lease has an implicit interest rate of 10% per annum, the end of the year payment would be recorded as follows. Let's try to figure this out. So what's the annual lease payment? 10,000. We need to break that down into principal and interest. What's the amount of principal outstanding? $57,590. What's 10% of $57,590? $5,795. So what's the principal portion? 10,000 minus, and this is the principal. Everybody see this? How this is done? How we break it down into, we just don't debit one account lease, expenditure lease. We break it into principal and interest. As long as you know what the balance was, you can calculate what the interest is. If you can calculate the interest, you can calculate the principal. This is in the debt service fund itself. Actually, this problem is one of your homework problems, doing this. This pretty much the same thing. Look at how it's recorded initially at the governmental activities level. All right, so I want you to, you'll get some practice when you do this question. Let's talk about debt refunding. Who's one of the biggest participants in debt refunding? The federal government. Every week they issue treasury bills. And what does that mean? What does debt refunding mean? debt refunding involves doing what? Yeah. Yeah, that's a good reason for it, right? Lowering your interest payments. And basically, there are a couple of reasons why we do debt refunding. Debt refunding very simply means taking the debt you have outstanding and replacing it with another form of debt. Why would you do it? As he said, you do it if the existing debt outstanding was at 8% and the current rate was 6%, it's like refinancing your mortgage. You want to take advantage of the lower rate, right? So that's one reason for it. Another reason, which unfortunately a lot of folks do, which is not a good reason, is that's it. How many of us do that? We have a mortgage outstanding, it's got 10 years left, and we say, you know what, I'm really young, and I can extend my mortgage a little bit more. My friendly banker out there said, I can make my 10-year into a 20-year mortgage, lower my payments, and he'll give me more money. What could be better? Don't fall for it, okay? Piece of personal advice, financial advice. The best feeling in life occurs when you are debt-free. I know it's hard to say this. It's the best thing that you can do for yourself. When you're debt-free, the feeling that you will have and the way you live is very different. So, piece of personal financial advice. But anyway, what's another reason? Another reason is that I know this is after I'm telling you after you spend all this money on this program, right? Okay. Yes, I know. I'm not trying to rub this in, but this is I say this in this case. I think I can say that it's an investment. Okay, it's not like buying a car. Okay, education is the best return of any investment you can make. And the other thing is, nobody can ever take it from you. They can take your house, they can take your car, they can do, but there's one thing they can never take, which is education. So I always say that that's the best investment you have. But going back to this, another reason we do this, as he said, lower the rate, extend the maturity of the debt. And the third is sometimes people lend you money or they lend money to government with very restrictive covenants. Like you can't do this, you can't do that. To get rid of those restrictive covenants, you want to do what? Pay off that debt. So you don't have to deal with that, those people anymore, because you don't like the terms of the loan that was made to you. So those are some of the three reasons. Those are the three reasons that that we use. And basically, the way it works is, and actually the book doesn't mention this, but there are two types of refunding. There's current refunding and advanced refunding. Current refunding is very simple. So I owe him money, $100,000. At 8%, she's willing to lend me money at 6%. So basically what I do in current refunding is tell her, could you make out a check for $100,000 to him? Direct transaction, doesn't even come to me. She writes the check out to him, that's done, now I owe money to, that's current refunding. Advanced refunding occurs where there's a gap. She gives me the money, and then I turn around and give him the money. What does that do? Well, I owe him money, but there might be a time when I also owe her money at the same time, right? Because the money's come in, right? And I haven't paid him yet. That's an advanced refunding transaction. Happens a lot in government. There is a rule, and again, not mentioned in the book, you can't go crazy with advanced refunding. I think under IRS rules, you can only do it once for each transaction, bond transaction. So, So just on a personal note, if you ever borrow money, always make sure that there are no clauses which prevent you from prepaying the loan. On any kind of loan, make sure there are no prepayment issues, meaning you can prepay the loan if you want to at any time without any penalties. So you always want to make sure that that's built into the agreement itself. And this is what I was saying. If all bonds are not retired by the end of the fiscal year, both issues would be reported as long-term debt and governmental activities. Shows you here the important thing is to understand why debt refunding occurs. And here basically the 100,000 goes out as other financing use for refunded bonds. And this is what I was talking to you about. Now, let's talk a little bit about one other area. This is another technical area, but you should know this has to do with bond defeasance. Anybody know what this means, defeasance? The word defeasance, it's a technical term. And it's associated with refunding transactions because this is how it works. If you have some debt outstanding and there were no prepayment clauses which precluded you from paying that bond off, if I have money either from her or someone else, and this bond that's outstanding is $1 million, I take the $1 million which she's given me or I get from another source and put it into an account with a trustee. I have effectively defeased the $1 million bond that he has. How does that work? And in reality, again, the book doesn't talk about this, but in reality what happens is there is a fiscal paying agent. It's your trust department of a bank or someone who collects money from you and writes out checks to all the bondholders. So what I do is I go to the trustee and I write a check and give it to the trustee and say, here's $1 million for the debt. And she looks at me and says, but this money isn't due for a few years. You say, no, I want to defease my debt. What I have done by depositing that $1 million into the account with the trustee, I've effectively did legal defeasance of the bond. The word is legal because I have given the trustee all the resources required to wipe off the debt. In substance, defeasance is slightly different. They're the same thing. Legal defeasance is once I do that, I give you $1 million. When I do my debt margin calculations, that debt isn't there. In fact, by my giving you $1 million to the trustee, I can remove that debt from my long-term liabilities because I've paid it. And actually, I was involved in a transaction like this, and in the real world, it works a little differently. So we needed $96 million to be paid in a series of cash flows over the next 5 years. What we did was we bought 5 zero-coupon bonds. And let's assume each one of them was, let's make this 100 million. And you needed $20 million to be paid to the bondholders each year. What I did was we bought a zero-coupon bond maturing 1 year from now. When it matured, it would mature exactly at $20 million. So we paid $19 million and change for that bond. The next bond, 2 years from now, basically we bought a series of these U.S. government strips and deposit it with the trustee, and we're done. We didn't spend $100 million. We spent less than that because we deposited U.S. Treasury strips. And the reason why he took them was because U.S. Treasury strips are not like your commercial. You know, he knows that when they mature, he'll have his money. So that's how, in reality, that transaction is done, is that you actually buy these instruments and you deposit them. So we basically did a legal defeasance. In substance, defeasance is a little different because there are some administrative issues where he might not be permitted to take money from me, and I need to set up a separate account, and there's a time period between the defeasance by the trustee. Again, I don't want to go too much into this, except let's put it this way. Legal defeasance is when the bond allows you to pay it off early. In substance, defeasance is when it doesn't say so, but you put the resources aside. Anyway, yeah. Yes, yes, when it won't allow you to do it early. Yes, when it won't allow you to do it early, you'll do that, okay, from a practical aspect. Legal defeasance is very easy. As soon as I write the check, he calls the bondholders and says, absolutely, absolutely, you're absolutely right. And that's why we buy zero coupon bonds, because we control how much it's going to earn. So if I owe somebody $1 million, I can buy zero coupon bonds for $996,000 today, and I know at the end of the year exactly $1 million will come to you because they are priced that way. If anyone's interested, and you should try to, this is great education, on the fourth floor, is it? Third or fourth floor? There's a Bloomberg machine. Anybody see that? Yeah, have you used it? Okay. If you, huh? You used to work at Bloomberg? Well, it's one of the best things that's out there in terms of financial information. If you can, get a student account. It's the machine which traders, investors, bond traders, stock traders, someday maybe you can tell us some more about it, but it's a wonderful device for you to learn. And if you ever get into the capacity of a CFO or money manager, you'll need to know what is involved. And you can basically, what it has a bond market, the stock market, you get live trading, stock market, bond market, fixed income, preferred, municipal market, real estate, currency markets. Each one of these, there's more than you'd ever want to know about. But it's a great way to learn about this area. As I said, all liabilities removed from the governmental activities. All right, we didn't do our polling questions, so let's try to do a few before we take a break or before we conclude. All right. Hold on one second. All right. Can you read this, or hold on? It's got the wrong chapter here. Can you read it? Okay. Actually, let me just make it bigger. What do you think? Oh, we're still going. Okay. We got a few more. I think that's it. I think we had 58. Okay. Oh, wow. Okay, you'll have to do better than that. The answer is revenue bond. Because as I said to you, revenue bonds are not in the governmental activities is what? The 5 different funds that we talk about, right? Proprietary funds are separate. So it is revenue bonds issued by an enterprise fund. Let's go to the next one. I expect 100% response on this. Okay, we got a few more. All right. Wow. Remember, I kept on using the word when it's legally due, legally payable. And I know you have, since this is new to you, but you need to, okay. Let me just make this bigger. So the question is, when do you show it in the debt service? When it's obligated, or when it's not obligated, or both, or either? Okay, almost done. It's some stragglers here. Okay. One more. Last chance. Okay. That's better. That's better. That's much better. It is, if it's not secondarily liable, then you don't show it. Okay, going back to the question, take a look at it again. Yes, you do need to. No, if it's not obligated for the debt. Okay. Actually, this is from the last class. See if you remember this. What happens to premium on bonds sent to the capital projects? Remember I talked to you about how are the premiums used? Where do they go? We have 2 more questions. Okay. Let's 2 more. Okay. All right. Come on. It's transferred to the debt service. Remember I said to you the premiums, if there's money, it goes towards paying off the debt itself. That's why it's transferred to the debt service fund. I hope this is not a depressing activity for some of you. Okay. Well, you know what? Maybe this will motivate, provide some motivation. I hope it's not negative motivation. Now, if you don't get the answer to this, you can't take the exam on Wednesday, okay? Okay, let's do this. We have 1 more and then we're done. So I think somebody's fallen asleep on me. There are 2 people who just would not. Okay. All right, 1 more. All right. Oh, good. Thank goodness. Okay. I was getting, so we still, why isn't all debt of the government? What kind of debt does the debt service fund not show? Debt of proprietary funds, because they are not shown. That's why it's not the entire government. It's just on the long-term debt itself. All right, let's do this last one. It's a little okay. So which bond will have the largest fund balance? Okay. So what do you think? It's D, which is the term bond.